This isn't speculation. This isn't a Reddit meme. This is a structural shift being forced by banking regulations that just went live, and it's going to create one of the most violent repricing events in modern commodity history. If you own paper, silver, gold ETFs, or you think precious metals are just for conspiracy theorists, you need to understand what's happening right now because the rules just changed. Banks are being forced to cover positions they've held for decades. Physical supply is tightening, and the gap between paper price and physical reality is about to close in a way that will shock most people. I'm going to walk you through exactly what Basel III regulations are doing to the silver market, why banks like JP Morgan are scrambling, and most importantly, what you need to do to position yourself before this window closes. But first, let me be very clear about something. I don't sell silver. I don't run a coin shop. I have no financial interest in you buying metals. What I do have is 5 decades of pattern recognition, and the pattern I'm seeing right now is identical to what I saw before every major monetary reset in modern history. Subscribe to this channel right now if you want to understand how markets actually work, not how they're supposed to work in theory. Join this community because what I'm about to explain, your financial advisor won't tell you. Not because they're evil, but because they don't understand the plumbing. Here's what most people don't know. For decades, the silver market has been a two-tier system. There's the paper market where contracts trade on exchanges, and there's the physical market where actual metal changes hands. In a healthy market, these two prices stay close together, but we haven't had a healthy silver market in over 40 years. The paper market has been systematically manipulated through a practice called naked short selling. Let me explain how this works. A bank writes a contract promising to deliver silver at a future date. But here's the trick. They don't own the silver. They're writing checks with no money in the account. By flooding the market with these paper contracts, they create artificial supply. Prices drop. Then they buy back the contracts at lower prices and pocket the difference. If that sounds illegal, that's because it is. JP Morgan was fined $920 million in 2020 for manipulating precious metals markets for over a decade. Not weeks, not months, a decade. This wasn't a mistake. This was a business model. And here's what should terrify you. That fine was just the cost of doing business. They made far more than they paid in penalties, but something just changed. Basel III, a set of international banking regulations, officially went into effect. And buried inside these technical rules is a reclassification that destroys the paper metals game. Physical allocated gold and silver are now classified as Tier 1 high-quality liquid assets. Banks can count physical metal at 100% of its value toward their capital reserves, the same treatment as cash or government bonds. But unallocated paper metals, the contracts banks have been using to suppress prices, are now classified as high risk. Banks holding unallocated positions must apply an 85% net stable funding ratio. In plain English, it just became brutally expensive for banks to maintain naked short positions. They now have two options: buy the physical metal to back their paper promises, or close the positions and take massive losses. There is no third option, and this is where the squeeze begins. Let me give you some numbers that should stop you cold. The silver market has an estimated paper to physical ratio of roughly 300 to 1. That means for every ounce of real silver that exists, there are 300 paper claims on that same ounce. Gold is slightly better at about 100 to 1, but still absurd. Now ask yourself, what happens when Basel III forces banks to actually deliver physical metal instead of just rolling paper contracts? What happens when industrial users, the companies that need silver for solar panels and electric vehicles and electronics, start competing with banks and institutions for the same limited physical supply? The paper pyramid collapses, and when it collapses, pricing doesn't adjust gradually. It reprices violently. I want to tell you about a conversation I had with a major metals dealer last month. This is someone who moves serious volume, institutional size orders. He told me delivery times have stretched to 4 months. 4 months to get physical silver, even though the paper price suggests supply is abundant. That disconnect tells you everything you need to know. The paper market is saying there's plenty of silver. The physical market is saying we're running out. One of these markets is lying, and it's not the physical market. You can't fake a metal bar sitting in a vault, but you can absolutely fake a contract promising to deliver metal you don't own. Here's what's happening right now behind the scenes. Banks are quietly unwinding decades of short positions. They're not announcing it. They're not holding press conferences. They're just buying physical metal as fast as they can without spiking the price too quickly. But here's the problem. There isn't enough available silver to cover all the paper claims. The entire above-ground supply of investment-grade silver is estimated at around 3 billion ounces. Sounds like a lot until you realize that's less than $400 per person on Earth. And a huge portion of that silver is already locked up in industrial applications, jewelry, or long-term storage. The float, the amount actually available for sale, is shockingly small. So when demand spikes, and that demand is not just retail investors buying coins, but banks covering massive institutional positions, supply can't keep up. And when supply can't keep up, price explodes. Now let me connect this to something most people aren't watching. China has been accumulating physical gold and silver aggressively. Official reports show they've added tons to reserves, but the real numbers are almost certainly much higher. Why? Because they watched what happened when Western governments froze Russia's foreign reserves in 2022. Assets that were considered safe became unusable overnight with a political signature. China is not going to let that happen to them. So they're converting paper dollars into physical hard assets that cannot be frozen, cannot be sanctioned, cannot be printed into irrelevance. And they're doing it quietly, month after month, through the Shanghai Gold Exchange, which, by the way, is a physical exchange. No fractional nonsense, no paper games, real metal, real delivery. The West is just now catching up to what China figured out years ago. Let me walk you through what happened in previous silver squeezes so you understand the pattern. In 1980, silver hit $50 an ounce during the Hunt Brothers episode. The exchange changed the rules mid-game. They restricted buying and forced liquidation. Silver crashed. The little guy got wiped out. In 2011, silver ran to $49. Then the CME raised margin requirements multiple times in just weeks. Leveraged speculators were forced to sell. Silver crashed again. Then in December 2025, silver hit a local high, and the same thing happened. Margin hikes, forced liquidation, price collapse. Every single time, the mechanism is the same. When silver runs, the exchange changes the cost of holding positions and forces weak hands out. But here's what's different this time. Basel III isn't a temporary margin hike. It's a permanent structural change. Banks can't just wait it out and go back to business as usual. The rules have fundamentally shifted. And that means the suppression mechanism that worked for 40 years is breaking. So what should you actually do? First, understand what you own. If you hold silver ETFs, go read the prospectus. Most of them have clauses that allow cash settlement instead of physical delivery. That means if there's a supply crunch, you might get paid out in dollars at a price that's disconnected from what physical silver is actually trading for. You think you own metal, you own a promise. And in a crisis, promises break. What you want is allocated physical metal. That means bars or coins stored in your name, insured in a professional vault. Not unallocated pool accounts where you own a share of a pile. Not certificates, not ETFs with fine print. Actual metal that exists is segregated and is yours. I personally only hold metals in professional storage facilities. Keeping large amounts at home is unnecessary risk, but the key is allocation. You want to be able to point to a specific bar with a specific serial number and say, that one is mine. Second, understand the difference between gold and silver in this environment. Gold is moving higher. Absolutely. It's broken all-time highs. Central banks are buying at near record levels. But silver has something gold doesn't. Dual demand. Gold is primarily a monetary metal. Central banks buy it. Institutions buy it. Wealthy individuals buy it as a store of value. Silver has that same monetary demand, but it also has massive industrial demand. Electric vehicles use silver. Solar panels use silver. Every smartphone, every computer, every piece of modern electronics uses silver. And there's no good substitute for most of these applications. So you've got monetary demand increasing because of Basel III and monetary instability, and you've got industrial demand increasing because of electrification and technology. Both forces are chasing the same limited supply. That's why silver, when it moves, tends to be far more volatile than gold. It's a smaller market, it's more leveraged, and when the squeeze happens, the percentage moves are bigger. Now, let me address the fear most people have. They look at silver at current prices and think I missed it. It's already at all-time highs. Why would I buy now? Here's what you need to understand. We are not in a normal market cycle. We are in a late-stage debt cycle where governments have printed more money in the last few years than in the previous century. The dollar's purchasing power is being deliberately destroyed to inflate away unpayable debts. In that environment, asking whether silver is expensive in dollars is the wrong question. The right question is, how many ounces do I own? Because when this reprices, it's not going to matter whether you bought at $30 or $60. What's going to matter is whether you own physical metal or whether you own a paper promise that gets settled in devalued currency. Let me give you a framework for thinking about position sizing. I'm not giving you financial advice, I'm giving you a mental model. If you believe the monetary system is sound, that central banks have everything under control, that inflation is transitory, and that paper assets will hold their value, then you don't need precious metals. But if you believe we're in the late stages of a debt cycle, that money printing is the only politically viable option, and that trust in paper currencies is eroding, then physical metals are insurance. And insurance has a cost. In good times, metals might underperform stocks. That's fine. That's what insurance does. It sits there. But in bad times, when your bonds are getting destroyed by inflation and your stocks are repricing lower because of rising rates and economic stress, metals hold value or go up. That 10 to 15% allocation could be the difference between preserving your wealth and watching it evaporate. Here's what I'm watching right now. Premiums. The premium is the amount you pay above the spot price when you buy physical metal. In a healthy market, premiums are low because supply is abundant. But in Shanghai, premiums have been elevated for months. That's not what you see in a market with easy supply. That's what you see when physical demand is overwhelming available inventory. And it's not just happening in China. Dealers in the US and Europe are reporting the same thing. Delivery delays, rising premiums, tightness in the physical market that doesn't match the paper price. That divergence is the tell. It's the market screaming that something is broken. Now let me connect this to the bigger picture because silver doesn't exist in a vacuum. We're heading into an environment where inflation is likely to stay elevated. The official numbers say inflation is cooling, but those numbers are curated. Housing costs are still rising. Wages are rising because people are finally demanding more after years of getting crushed. Tariffs are adding costs. Government spending is out of control. We're looking at deficits of over $20 trillion in the next decade. And how does that get paid? By printing money. When you print money, each dollar buys less. That's inflation. And inflation is a hidden tax on everyone holding cash and bonds. But it's a tailwind for real assets, things that can't be printed, things that have intrinsic value, things like silver. The Federal Reserve is cutting rates right now, even though inflation hasn't been fully defeated. Why? Political pressure. We're heading into a major election cycle and nobody wants a recession on their watch. So they're cutting rates to goose the economy in the short term. But here's the problem. Rate cuts are inflationary with a lag. 12 to 18 months from now, we're going to see the consequences of today's decisions. And when inflation comes roaring back, the Fed is going to be trapped. They can't raise rates aggressively because the government can't afford higher debt service costs. So they'll let inflation run. And when inflation runs, hard assets win. Let me tell you what happened to someone I know. Call him Robert. He's 57 years old. He spent 30 years building a retirement portfolio, mostly stocks and bonds, traditional 60-40 allocation. He thought he was being responsible, diversified, safe. Then 2022 hit. Stocks dropped, bonds dropped. For the first time in his investing life, his safe assets and his risky assets both got crushed at the same time. He lost 18% that year. And here's the thing, he's 57. He doesn't have decades to recover. He needs that money in less than 10 years. Robert called me in a panic asking what to do. I told him the same thing I'm telling you. The 60-40 portfolio was built for a world of falling interest rates and low inflation. That world is over. In a world of persistent inflation and monetary instability, you need real assets. You need things that hold value when currencies are being debased. Robert didn't listen at first. He stayed in bonds. And over the next year, he watched inflation eat another 6% of his purchasing power while his bonds went nowhere. By the time he finally moved a portion into physical metals, he'd already lost years of compounding and a huge chunk of real wealth. Don't be Robert. Here's the action plan. First, decide what percentage of your portfolio should be in hard assets. For most people approaching retirement, 10 to 15% is reasonable. Not so much that you're betting everything on one outcome, but enough that if the monetary system cracks, you have real protection. Second, buy physical, not ETFs, not mining stocks, not futures contracts. Physical allocated metal, coins or bars, stored professionally, insured, in your name. Third, dollar cost average. Don't try to time the perfect entry. Build your position over months. That way you average your cost and you don't get caught trying to catch a falling knife or chase a runaway price. Fourth, ignore the noise. Silver is going to be volatile. There will be days it drops 10%. There will be margin hikes. There will be media saying the bull market is over. None of that changes the structural thesis. The paper market is breaking. Physical supply is tight. Basel III is forcing covering. The squeeze is real. Now let me address the people who are going to say this sounds like a conspiracy theory. I get it. For decades, we've been told gold and silver are relics, barbarous remnants, no yield, no cash flow, just shiny rocks. But here's the thing, Basel III wasn't written by conspiracy theorists. It was written by central bankers and international regulators. And those same people just reclassified physical gold as a tier 1 asset, the same status as cash. Why would they do that if metals are worthless? The answer is simple. They know what's coming. They know the monetary system is under stress. They know trust in paper currencies is eroding. And they're quietly moving the goalposts to make sure the institutions they care about, the big banks, survive what's next. You can call that a conspiracy if you want. I call it pattern recognition. Here's what I want you to do this week. Go look at your portfolio. Actually open it. Look at what you own. How much is in cash? How much is in bonds? How much is in paper assets that depend on the system functioning smoothly? Then ask yourself, if we're entering a period of monetary instability, does this allocation make sense? If the answer is no, then you need to reposition. Not next month. Not after you see how the next quarter plays out. Now, because the window is closing. Physical metal is still available, but it's getting harder to source. Premiums are rising, delivery times are stretching. And once the crowd figures out what's happening, once the panic buying starts, you won't be able to get metal at any reasonable price. The people who position now are the ones who